What up, nerds? My name is Luke. I help people interested in crypto increase their savings and grow their wealth through the power of DeFi. So, today is the 9th of November, and yesterday and today has been a brutal day in the markets. Like, if you're in cryptocurrency right now, then you know how bad it's gotten. We'll see right here that absolute red all around. Brutal losses in pretty much every asset and an insane spike in volatility. Now, I'm not going to go into the reasons why this is, but the fact that this has happened and it's currently still happening and probably will happen for the rest of the week gives me a good time to talk about risk and portfolio construction. So today I'm just going to talk about a good way, or at least the way that I construct crypto portfolios, and I'm going to take a lesson from the Cockroach Portfolio. So let's get started. Right, on this channel we preach the way of the tortoise. This is the goal of maximizing our long-term wealth. And how you do that is you have to construct a portfolio that has the highest compound growth rate. So you want to maximize your returns every period or every year so that you can have as much wealth at the end as possible. So the big lesson that you get from the Cockroach Portfolio is that you should allocate your investments and construct your portfolio to the fundamental different drivers of returns, or the fundamental different regimes that can happen. And that is risk on and risk off. So, what is the Cockroach Portfolio? Cockroach Portfolio is a idea by Mutiny Fund. It's a portfolio construction that tries to ensure long-term growth and long-term wealth of an investment portfolio. Now, it's similar to my own personal thesis, my own philosophies on portfolio construction. However, it's applied to all assets. So this is the macro portfolio. This is like a proper investment portfolio. And the big fundamental idea behind this is that to have true diversification is you want to diversify across the fundamental risk drivers. Now, here's an example of what someone might think what they might think a diversified portfolio is. You know, let's say you have some stocks, you have some real estate, hedge funds, commodities, private equity, etc. And yeah, you have a lot of different types of assets here. However, fundamentally, they all have the same risks and risk profiles. And that is, when the market's doing well, when you're in a bull run, they do well. But then when the market goes risk off, as in everyone's trying to rush out of these risky assets, the regime changes, maybe there's high inflation, economic growth slows down, they all correlate and they all go down together. And as you can see, here's different percentages in the 2008 crash. So are you diversified? Well, no, they're all going down together, right? So what you want to have is you want to have a portfolio that has some assets that do well in these risk on times, in these bull markets when everything's going well, when there's no issues. And then when people go risk off and they're trying to pull their money out and the liquidity dries up, you want to have assets that do well in this kind of regime. So what they say is you have offensive assets and defensive assets. You have, let's scroll down to see what a macro offensive and defensive asset might look like. So you have your stocks and your bonds in your offensive. So when you're in your bull market, everything's going well, you're making your returns. And then in the defensive side, you have assets that are fundamentally uncorrelated to the market. So if the market's going up, the market's going down, they still make some returns. So these are your, like, the defensive sides. And actually volatility is sometimes negatively correlated to the market, depending on the type of volatility that you're invested in. Now, with the Mutiny Fund, these two, the defensive sides, are actually trading strategies. So they are investing in managers who trade futures and options and things to try and get this volatility and trend premiums. So again, you have your offensive and you have your defensive, and they said simply you have put 50% of your portfolio in offensive assets and 50% in defensive assets. So this, I think, is a great framework to use, and it will work in crypto too. Now, while crypto might have its cycles that happen more frequently, maybe every 4 years compared to, the 10-year macro business cycle, you can still use the exact same framework to try and maximize returns through portfolio construction. So what's the big takeaway? The big lessons is you have two fundamental regimes, risk on and risk off. 50% of your portfolio should be on these offensive risk on assets and 50% in these defensive risk off assets. So how does this apply to crypto? Like, what are offensive assets in relation to crypto? Well, I would say any crypto asset that you're just simply going long when you're buying and holding is a offensive asset. It does well when the market's going up, when there's bull markets, but when the market goes down, when volatility spikes, just like right now, they do pretty poorly. So that's it. Your Bitcoins, your Ethereums, your DeFi tokens, and whatever else you might be investing in that are legitimate crypto investments. Similarly, you have short volatility positions. These are things like liquidity providing in DeFi dexes in liquidity pools, and you also have options selling. Those are both fundamentally short volatility, meaning when volatility is low or it's lower than you expect, they perform pretty well. The reason, I'll explain in a different video why LPs are fundamentally short volatility. For now, all you need to know is that if you put on an LP position, impermanent loss will make you lose if volatility is higher than expected. Okay, so simple. That's what most people's portfolios are full of. You have a lot of people going long BTC. You have a lot of people who might be bullish on Ethereum, and maybe they even LP their Ethereum. But effectively what they're doing is they have 100% risk on. So what would be a defensive asset? How can we balance our portfolios with different defensive assets? Well, you have similar different assets as you can have in the Cockroach portfolio. You can have long volatility strategies, and you can have trending strategies. And these would be, as you see, long volatility is strategies involving option buying, trying to catch that convexity and trying to pay a premium so that when the market goes crazy like right now and the volatility spikes insanely, that you can actually profit. So while your crypto coins, your BTCs and Ethereums are crashing, you actually profit from these options that you had. Similarly, if you can invest in people who are good at futures trading. Futures trading is fundamentally, or at least it should be fundamentally, uncorrelated to the market, because they can trade the trend when the market's going up, and they can trade the trend when the market's going down, right? And when it's a choppy market and volatility is low, then they still should be able to make money, but maybe less so. And finally, interesting, what we have in DeFi that you might not have in the traditional market is stablecoin yield. So anywhere in DeFi where you can get a stablecoin yield, like liquidity providing on different dexes or lending your stablecoin assets. And the reason I would say these are defensive assets as opposed to something in the traditional finance, which is bonds, is because these are a lot of the time over collateralized. Meaning if some major liquidity issue happens, or some major crisis like right now, you're not going to have defaults. You're not exposed to a business going bust, because these are all on-chain smart contract protocols. They can't go down. The market doesn't control whether these are up or not. It doesn't control whether or not you're going to get paid back. It doesn't control the interest rates. In some sense, it controls interest rates, because in good times, people want to borrow more to maybe leverage up, and in bad times, maybe there's less demand for the liquidity. However, that just means the magnitude of your returns might be correlated to the market, but the risk is not correlated. It's fundamentally uncorrelated, in my opinion. So that would be a great, and it is the major defensive asset that most people in DeFi have. So currently, what's my portfolio? I mean, my portfolio currently is about 65% offensive assets and about 65% defensive assets. And the reason I have more percentage than 100 is because I actually have leveraged a little bit. So I have some Bitcoin, Ethereum, I have some LP positions, some leveraged LP positions that I'm currently not doing great because of the really high volatility. I have quite a few defensive assets. So my defensive assets are some stablecoin LPs. I have some lending, and as of yesterday, I've also done a bit of long volatility options trading that helped me weather this storm right now. Actually, while my portfolio should have been down around, I think, 10% from the crazy crashes yesterday, I managed to make that 10% back from the volatility. So I'm effectively zero at the moment. So I would suggest you to think about all the different assets, all the different things that you are invested in, and seeing how much you have in risk on and how much you have in risk off. And this will give you an idea of whether you're too allocated to the good times or how much risk you might be taking on. So this is a really simple, really good method, I think, for constructing a portfolio. I mean, one of the traditional ways of constructing portfolios I see from other videos and other articles is this, high risk, medium risk, low risk type of construction, where they say you should have mostly low risk, you should have some medium risk, and you should have a small bit of high risk. Now that kind of makes sense, but if you have them low, medium, high, and they're all risk on, then what happens when you have a risk off event? What happens when it's a bear market? Right, you're just going to lose. You're just going to completely lose money. It's not really diversified at all. All the assets you have are all correlated. They go up together and they go down together. It's just the size of the returns are different. So what I would say is you have 50% risk on, 50% risk off. And honestly, that doesn't mean that the risk off or the defensive assets have to be low returns. Now, I've actually have high return defensive assets, which have very, very high risks. However, the risks are uncorrelated to the market risks of my offensive assets. And that's the important, right? You can have high return, high risk portfolio, but be better diversified and have the construction a little bit better if you think of it in this kind of way. So I hope that gave you a bit of insight. I hope maybe that helps for going forward in the future. Now, this is certainly a really bad time in crypto. It's a really, really tough market, but it won't be the last, right? This is going to happen again. It's going to go up really high again, and it'll crash again. Such is the nature of cryptocurrencies, and the fact that we don't have specific values or arbitrages to try and keep it in a specific range. So you're going to see this many, many more times. So just make sure that you allocate such that you don't have to predict the future. You just have it set up so that it'll do well in good times and it'll do well in bad times. So I hope that helped. If you find it interesting, like this video, and if you want to see more and you want to try the way of the tortoise as well, then subscribe and keep up to date for more content.